Okay, we'll get started. Welcome, and thank you for joining us for Elder Climate Action's March National Call titled The Climate Impact of Fossil Fuel Investment on Insurance Companies and Homeowners. This is one of climate change's many tentacles that we haven't previously presented, with the prospect of making home ownership too risky and insurance even more unaffordable or even unavailable. I am grateful and happy to introduce today's speaker, David Jones, on this important and interesting subject. Before doing so, my name is Mark Cook. I am a co-chair of ECA's Education Committee. For those of you who are new to ECA, again, welcome. We are grandparents, great uncles, great aunts, and everyday folks determined to do all we can to leave a livable planet for future generations and all life. Our programs, communications, and chapters are focused on engaging elders in solving the climate crisis. At ECA, we are elder-centered and volunteer-driven, seeking to inform, inspire, and engage older generations to take action on the climate crisis at the local, state, and federal levels. It is my pleasure to introduce you to Dave Jones, Director of the Climate Risk Initiative at UC Berkeley School of Law's Center on Law, Energy, and the Environment, and formerly Director for Environmental Risk at the Nature Conservancy from January 2019 to June 2021. Before then, Dave served as California's Insurance Commissioner from 2011 through 2018 and founded and chaired the Sustainable Insurance Forum, an international network of insurance regulators developing climate risk regulatory best practices. Dave was the first U.S. financial regulator to require disclosure of investments in fossil fuel assets due to concerns about climate change-related risks, and the first to conduct climate risk scenario analysis of insurers' investment portfolios. Dave is a graduate of DePauw University, Harvard Law School, and Harvard's Kennedy School of Government. Dave, please take it from here.
Thanks, Mark. That's very kind, and it's a treat to be with you and all of your viewers and ultimately everyone connected with Elder Climate Action. What I'm going to talk about is the way in which the climate crisis is driving the insurance crisis. I'm going to talk about ways in which insurers are contributing to the crisis, some things that insurers could do to address the crisis, and then what we need to do in terms of state level policy actions and legislation to address this situation as well. To start, I think it's important to underscore that insurance is really the climate crisis canary in the coal mine, and the canary is dying. What we're seeing across the United States with varying levels of acuity is insurers decreasing the amount of property and casualty insurance they're writing for homes and businesses and for multifamily structures and for permanently affordable housing structures, as well as raising price. And just to put this in perspective, sadly, we're not alone in the United States in terms of what's happening. The global insured natural catastrophe losses last year in 2024 were $154 billion. That's a record, which breaks the record from the prior year, which breaks the record from you kind of see where I'm going. $154 billion in insured natural catastrophe losses exceeds the 10-year average of global natural catastrophe losses, and the trend is all in a bad direction. In the United States last year, we had about $116 billion in insured natural catastrophe losses, and about half of that was from a peril which has historically not been a big problem, but which climate change is now making a big problem, a peril called severe convective storms. Now, it is the case that as global temperatures rise, what's happening is we're seeing more severe and extreme and frequent weather-related events, whether it's wildfires, drought, extreme heat, hurricanes, tornadoes, other wind-related events. That's just a partial list of all of the perils that are landing because of climate change and getting worse. But I think it's important to note that the climate is changing so substantially that they're essentially perils that historically have not been a big problem that now are looming very large. And one of those is severe convective storms, or what gets referred to colloquially as atmospheric rivers. So it's understandable. As temperatures rise, the atmosphere holds more moisture. As climate patterns change, that moisture hovers over some geography, comes down as heavy rain for a sustained period. Now, it's bad enough that that's causing more flooding, but private insurers don't cover flood. They got out of that business about 70 years ago, so flood risk for properties is covered by the National Flood Insurance Program. But it's just the heavy rain, sustained rain, damaging homes and businesses that is causing more damage and more insurance payouts. And last year in the United States, about 50% of that $116 billion was from these severe convective storms. And the year before that, it was about that too. Now, if you'd gone back 20 or 30 years ago and asked about severe convective storms of insurance professionals, they would have looked at you blankly. So not only is climate change making worse that have historically been a problem, like that list that I just gave you, but it's amplifying perils that have historically not been a problem. And severe convective storms aren't just limited to the West where wildfires are, or to the Gulf Atlantic coast where hurricanes are, or New England coast. Severe convective storms are landing across the United States and everywhere but the desert. So how do insurance companies respond to these increased losses in the United States and globally? They do two things simultaneously. They raise price and they write less insurance. And in terms of home insurance and business property insurance, the way the writing of less insurance manifests is non-renewals. Remember, these are one-year contracts, and at the end of which the insurance company decides whether to renew you. And increasingly, across the United States, insurance companies are deciding, because of their losses from climate change, not to renew homes and businesses. The other way in which they write less insurance is just to stop writing any new customers. If you're trying to buy a condominium or home for the first time, or you're moving from home A to home B, they won't write you insurance. Now, there's some 18 states across the United States in which this is occurring, this decreasing of writing of insurance. And then across the United States, the price is going up as insurers increase the price to try to capture more premium to cover their increased losses. So this is not just a Florida, Louisiana problem. It's not just a California problem. It's a United States problem. There's no get out of free card in climate change. So I think another thing that's important to understand, though, is that there's common consensus that a major driver of climate change in this country and globally are the emissions from the fossil fuel industry and our utilization of fossil fuels in transport and energy in a whole host of different ways. And so one of the things that's most striking about what's happening with regard to insurance availability and pricing, where things are just getting worse and worse, is that the insurers themselves have over $500 billion invested in the fossil fuel industry. That's just US insurers. Over $500 billion invested in the fossil fuel industry, which raises the following question, I think may have occurred to you as you're watching this. Why are insurers who are increasingly telling homeowners and multifamily structure owners and business property owners they can't afford to insure them any longer because of the losses driven by these severe and extreme and growing weather-related events? Why are they investing and financing the very industry whose emissions are a major driver of the temperature rise and the climatic change and the very severe and extreme weather-related events that are getting worse? Why are they investing in the very industry that's posing an existential threat to their industry? Well, there's really no good answer. I think what the insurers would argue is, well, we're getting good returns. But that's not a sufficient answer, because at the same time, we're getting less insurance because of the emissions from fossil fuels and the impact on the ability of insurers to keep writing even at the highest price. So one of the things that I think we need to do, and states can enact legislation to do this, is require insurance companies over some reasonable period of time, say a couple of years, to transition out of their investments in the fossil fuel industry. And for good measure, they're insuring the fossil fuel industry too. There was a report that was put out by Insure Our Future, which is a global NGO or nonprofit that does advocacy in this space, and they found that global insurers collectively have about 11.5 billion in premiums they collect annually from insuring fossil fuels. So we can and should do something about this. And so there is a bill that's been introduced in New York last year, and I believe you're going to be given a link to it potentially, that would require insurance companies doing business in the state of New York to transition out of their investments in fossil fuels. And this makes a lot of sense to me and is a way that states can make sure that insurance companies are contributing to the solution, which is the transition away from fossil fuels towards a clean energy economy. Second, there's a bill that's been introduced in Connecticut that's active right now that would impose an additional surcharge on the premium of Connecticut insurers that they're collecting in insuring the fossil fuel industry. And that money then could be used for adaptation and resilience, but it also is a way of trying to make sure that insurers know that there's a real cost to their insuring this industry, and they're going to need to help pay for that cost. Now, another approach, though, is to more directly hold the fossil fuel industry accountable for its emissions and for the consequent climatic conditions that are in turn causing more losses for insurance companies and causing them to raise price and write less insurance. And so there has been a bill introduced in California, Senate Bill 222, which would create a new private right of action for private individuals and businesses to bring lawsuits against the oil and gas majors for damages associated with their emissions contribution to climate-driven extremes and severe weather-related events that are causing physical injuries and damaging more property. That bill also does something incredibly important in addition to that new private cause of action, and that is it encourages insurance companies to bring their own lawsuits against the fossil fuel industry. Now, this requires a little explanation. Every insurance company has what's called a right of subrogation, which is a legal right to stand in the shoes of their policyholder and bring lawsuits against third parties whose actions or inactions are causing damages to the policyholder, which in turn is causing the insurance company to have to pay out money. Perhaps the best known example of this is the insurance companies in California suing electrical utilities because their equipment started wildfires, which burned down communities, which caused insurance companies to pay out billions of dollars. Well, in the PG&E bankruptcy, insurance companies brought subrogation lawsuits against PG&E a couple of years ago after the 2018 Camp Fire, which PG&E's equipment started. And the insurers collected $11 billion to repay themselves for money they had paid out to policyholders because of that fire. Insurance companies can and should bring subrogation lawsuits against the oil majors, just as states and local governments have brought lawsuits against the oil majors for their emissions contribution to losses. Insurance companies can and should do so. So another thing that Senate Bill 222 does is it incentivizes insurance companies to do this. It also places a duty on the insurer of last resort in California called the California Fair Plan, which was set up to write insurance for the risks the private insurers wouldn't write. It places a duty on the California Fair Plan to bring these lawsuits too. Now, 35 states have these fair plans. They're in red states, they're in blue states. So other states could also adopt legislation, creating a private right of action against the oil and gas majors, encouraging insurance companies to bring subrogation claims, but also requiring their fair plan to bring subrogation claims against the oil majors in appropriate circumstances too. Now, just a word about how this crisis is landing. Perhaps not surprisingly to all of those who are watching this webinar, it's hitting hardest those who have the least. So when you think about it, who is least able to afford rising insurance prices or the unavailability of insurance? Well, first, low-income households who may have gotten onto the home ownership ladder, have a mortgage, think they have a fixed mortgage for 30 years, where they think they have some understanding what that mortgage is going to cost. and all of a sudden they start seeing their insurance price rocket up year to year. So we're starting to see some evidence of an increase in mortgage defaults in areas where insurance pricing is going up. There was a study done by the Federal Reserve of Dallas that looked at this very question across the United States and found, sadly, an association between increased mortgage defaults and increased insurance pricing. The other way that this is landing most severely on low-income households, though, is it's making it harder for both operators and owners of permanently affordable rent-restricted housing to keep affording the operation of their permanently affordable housing complexes. And it's also making it more challenging even for market rate multifamily rental housing owners and operators to keep up as well and to provide a rent that, even at a market rate, is ideally somewhat affordable. And so there was a study done by the Minneapolis Federal Reserve that was released the other month that surveyed within that Federal Reserve Bank's jurisdiction permanently affordable housing developers and owners, as well as market rate rental property owners. And all of them said that they were having severe challenges and real pressures and stresses in terms of insurance pricing for their properties. There's also some evidence too that this insurance price increase is discouraging the development of more permanently affordable housing because much of that housing relies on federal and state low-income housing tax credits and various subsidy streams. But the operators promise to make the housing affordable that the rents will stay restricted. Well, as insurance prices go up, it's very hard to make that promise. And so this is increasingly a challenge for those that want to develop more permanently affordable housing. So I wish I could tell you that there was some major insurance regulatory change other than those which I've described that will fix this problem. There is one other thing that would help, and that is we know that investments in adaptation and resilience, or what we call in the insurance context, mitigation, works. Now, I'm not talking about mitigation as it's commonly understood in the climate policy context, where that's really about reducing greenhouse gas emissions. In the insurance context, I'm talking about things that reduce the risk that a home is going to blow away in the case of wind or the home that's going to burn in the case of fire. So we do know, and there's a bunch of empirical evidence and scientific evidence behind this, that you can take steps at the property level to make your home less likely to burn, less likely to blow away, less likely to be damaged by a whole host of different perils. In the wildfire context, it's called home hardening. So it's doing things to make sure that your home is less likely to burn. So no attached structures, using shatter-resistant windows, so when the heat of the fire comes, the windows don't shatter, the embers don't blow in, protecting the eaves of the home so embers don't get in the attic, using materials on the roof that are more impervious to fire, a whole list of things, right? And then there's defensible space. Within 5 feet of your home, not having any vegetation. Within 30 to 100 feet, dramatically reducing the amount of vegetation. These things work. We also know that nature-based investments reduce risk as well. So it turns out that if we mimic the way that nature used to manage our western forests, where fire was a routine part of the ecology, would burn through the forest, reduce the amount of small trees, reduce the amount of vegetation. Fire was a routine part of the western forest ecology, and it kept our forests more open and less likely to have fire in the crowns of the trees where it gets very severe and catastrophic. Well, we've had, 170 years of Western settlement, fire suppression, genocide against Native American peoples who used to engage in cultural burning, and our forests now are choked with fuel. Well, the good news is that the U.S. Forest Service and a number of states and local governments and homeowners associations understand that better managing the forest makes a difference. So there's a lot of what are called forest management or forest treatment projects going on throughout the West, using controlled fire, using thinning, not clear cutting, but thinning, that reduces the severity of wildfire risk. In fact, the state of California, for example, has appropriated $3.6 billion over the last couple of years for forest treatment, and the voters just enacted a climate bond in November that has about $1.5 billion more for forest treatment. So this is great. We need to do more of it, and there's a lot of it going on. However, and here's the kicker, despite these billions of dollars of investment in mitigation, whether it's at the property level by homeowners or homeowners associations or cities or towns, or at the state or national level, the models the insurance companies use to decide how to price the insurance and decide whether even to write you the insurance don't account for that mitigation. Now, some states have enacted regulations like California requiring a little discount if you do home hardening in defensible space and you're in a fire-wise community, which is a sort of a collective of folks that are working on trying to reduce the incidence of fire in the community. That's terrific. But the discount doesn't help you if they won't renew or write the insurance for you. And so in case after case, homeowners will do home hardening, defensible space. They're in a community that's doing mitigation. They're adjacent to a forest where landscape scale, nature-based mitigation is occurring, and they still get non-renewed. Or they're along the Gulf and Atlantic coast, and they meet the Fortress Home Standard. They invest tens of thousands of dollars in making sure their home doesn't blow away and their roof doesn't blow away, and they don't get renewed. So there is something states could do about that, is pass laws that require that the models used by insurers to price the insurance, and even more importantly, to write the insurance, to decide whether to write or renew the insurance, require those models to account for proven mitigation measures. That would be a path to try to keep insurance available in places where increasingly insurers are pulling out. And it would also generate more public support for the kind of mitigation we're going to need to invest in increasingly to try to reduce the incidence of death, injury, and damage of property due to these severe climatic events. But ultimately, even though these things that I've described to you will make a difference and are important things we should do, if we don't get our handle around rising global temperatures, that rising risk associated with those rising global temperatures will overwhelm these intermediate steps that I've talked about that can and should be undertaken. So ultimately, it all comes back to climate change and addressing that. And we've got to just simply redouble our efforts. And at a time when the federal government is going in absolutely the wrong direction, it's so critically important that Elders for Climate Action continue to support work at the state level and at the local level to try to address the climate crisis if we want to avoid an uninsurable future. And that is what we are marching steadily towards in this country, is an uninsurable future. So I'll stop there. I'm happy to take questions. That was a lot of insurance detail for you. I appreciate your kind attention, and I'm looking forward to receiving some questions about this.
Okay, I'll start by just taking these in the order they came. And the first is, are there places, again, I think homeowners insurance tends to be state, so probably states that prohibit retirement pensions from investing in fossil fuel companies because of the the future failure risk in those industries?
Not yet. There are some public pension funds at the state and local level that have adopted policies or guidelines to look at the climate risks presented by various categories of their investment. And there are some like CalPERS and CalSTRS. CalSTRS is the teachers' retirement system in California. CalPERS is the public employee retirement system, which have actually announced goals to, over time, try to transition their overall portfolio away from greenhouse gas emitting industries to clean industries. But none have yet said they're simply not going to invest in these things. The only exception might be coal and tar sands. There are some public pension funds that have said, look, we're simply not going to invest in that. Now, there have been state bills proposed in various states to require public pension funds to transition from fossil fuels. Those bills, to my knowledge, have not been enacted.
Okay, thank you. As we are looking to buy insurance for our homes, can we check out what the insurance companies are invested in so we can try to avoid those companies heavily supporting the fossil fuel industry? And I think you basically have touched on that a little bit with disclosure.
Well, that's terrific. That's a great question. And so when I was California's insurance commissioner in 2016, as Mark alluded to in his introduction, I required all the insurance companies doing business in California to disclose their investments in coal, oil, and gas, and utilities that derive more than 50% of their electricity from fossil fuels. And since most, if not all, major US insurance companies are in California, I was able to reach probably about 40% of the market just by virtue of that request. And so what I set up was an online portal that still exists to this day at the California Department of Insurance website. You got to search around for it a little bit, but you can do searches by company name and actually see to what extent they're invested in fossil fuels. Now, it's a little bit dated. That survey that I instituted in 2016, the last time it was done was, I think, 2021. So, it could be updated, right? But a lot of those investments haven't changed very much since then. So at least it gives you some measure of the extent to which, the insurance company you're looking at may be invested in fossil fuels. Sadly, despite my encouraging other states to do it, they didn't. I also asked insurers to divest from coal. I didn't have enough evidence that any given insurance company's investment in coal was sufficient to imperil their financial solvency, so I couldn't order them out of coal. But I suggested as their regulator that coal was a bad bet. At that point, 2016, the Dow Jones coal indices had dropped 92%, 35 coal companies had gone bankrupt, the 5 major US commercial banks had said they weren't going to lend into coal. So my view as a financial regulator, not as an environmentalist, but as a financial regulator, was I don't think coal is a good investment, right? And one of the primary jobs of an insurance commissioner, he or she, is to make sure that insurance companies are invested in things that retain value so that they have money to pay future claims. So I concluded after a lot of study that coal was a bad investment, asked them to get out, and that resulted in about $4 billion or so, maybe close to $5 billion in divestment from coal. Sadly, since then, no other insurance commissioner or federal financial regulator has done that. But I think it's an example of how disclosure and even requests by a regulator can make a difference. So that's the website you can go to look. It's a little bit dated, but that is the only source I'm aware of that has detailed information by company that you can actually search.
Great, thanks. This is also an interesting question. Is it in maybe part of the disclosure or not? Any chance that the insurance industry makes more money on their investments than they do on their premiums? So I guess their investments in fossil fuel or other businesses that harm the environment.
I'm sorry, I was reading the chat and
Oh, okay.
can you repeat the question? I apologize.
Yeah, no, it's in there also, but it says any chance that the insurance industry makes more money on their investments than they do on their premiums from homeowners insurance?
Oh, that's a terrific question. So Insure Our Future looked at that very question in the report they issued last year. And what they concluded was that the percentage of insured natural catastrophe losses that are related to climate change exceed the premium they're collecting from the fossil fuel industry. So that's a great study to look at that answers that question, and it walks through the numbers globally, and I think those hold up in the United States as well. Terrific question.
Okay. How do insurance companies that write policies across the country price their policies for different parts of the country? Is it possible to compare the prices of similar policies?
Yes and no. So, unlike any other financial product in the United States, insurance is regulated at the state level, which is probably a good thing at this moment in our national history. But every other financial product, by and large, is regulated at the federal level, not insurance. So insurance laws are done by states, and insurance regulation is done by the state's insurance commissioner, and all 50 states and the District of Columbia and 6 territories have an insurance commissioner. The laws are reasonably consistent because there's an entity called the National Association of Insurance Commissioners, which is the standard setting body for insurance regulation in the United States, and it promulgates model laws and model regulations. And as a credentialing requirement, states have to adopt those model laws and model regulations. So that's how we have some degree of consistency. 12 states actually regulate the price of property and casualty insurance, only 12. This is what's called prior approval, where the home insurer or auto insurer or business property insurer has to file their rates with the state. And then the State Department of Insurance in those 12 states says either yay or nay, or that needs to be adjusted in some way, shape, or form. The rest of the states are what are called file and use with some modification, mostly file and use, where the rates get filed and the insurers can use them right away. There are some sources for comparison across states with regard to insurance pricing. If you go to the National Association of Insurance Commissioners website, they have an annual report that they publish with regard to sort of average pricing of home insurance for a house of the same size across all 50 states and 6 territories. Another source for that is the Consumer Federation of America has done a bunch of insurance analysis and research, and so they have some similar information. It's really hard, though. It's hard to compare by company. These are sort of averages across state for the home insurance policy line and various other lines. To compare by company is, I mean, technically you can do it, but it's a much more challenging exercise to do.
Okay, great. At least there's some sources people can go to. Okay, if insurance companies stop insuring communities, it will affect the housing market. In other words, can't get enough insurance, can't get a loan. Can you speak about this?
Yes, the viewer is absolutely correct. There's a climate risk transmission channel here. So climate change is increasing risk. That increased risk is causing greater insurance losses. That's causing insurers to raise price and write less insurance. That in turn then has implications for people's ability to afford mortgages, as I described a moment ago. In those markets where supply and demand of housing is in reasonable equilibrium, it can also cause housing prices to decline. Now, in those states where housing supply and demand is not in equilibrium, like California, where we're about 2 million housing units short of demand, we're not seeing any absolute price impact from rising insurance prices. Why? Because the mismatch between demand exceeding supply is causing prices to be so high that it's washing out the impact of insurance pricing on home prices. But in other markets across the United States, there is some evidence that rising insurance prices and lack of availability of insurance is having an impact on the resale price of homes or condominiums. Then the other impact, as I described a moment ago, is on people's ability to afford a mortgage. So I don't know if you saw the other week, Jerome Powell, the chair of the Federal Reserve, testified before Congress, and what he said, and I'm paraphrasing, is that in 10 or 15 years, there will be parts of this country where people won't be able to get a mortgage because the insurance price is too high or the insurance is not available. Then there are also implications for mortgage lenders. So mortgage lenders require in every mortgage contract in the United States of America that people keep their insurance. And if you drop your insurance because you can't afford it or you can't find insurance, and you're not in a state that has what's called a residual market or a fair plan that's required to write you insurance, then the mortgage lender can force place insurance on you. Well, as you can imagine, the forced place insurance oftentimes is higher than the private insurance, which the homeowner decided was too high to afford anyways. So then they start getting a bill from their mortgage lender that has not only the principal and interest payment and the taxes if they're doing that through escrow, but now a substantially increased insurance price. And so that then can lead and is leading to more defaults. So what does that mean for mortgage lenders then? We're not at this place yet. We're not at a crisis with regard to mortgage lending, but to the extent that mortgage lenders keep these mortgages for high-risk homes on their books, it can cause financial consequences for the mortgage lenders. Now, the mortgage lenders recognize this, and so what they do, and there's evidence of this, and there was a study recently done by the New York Fed that found that in Florida, for those homes that have mortgage loans where the home is insured by an insurance company rated by a lower tiered rating agency called Demotech, and just to give you a flavor for how well that's going, 10 out of the last 10 Florida insurance solvencies were Demotech rated insurers. The mortgage lenders recognize that the home that they're loaning money to is insured by an insurance company that's rated by a lesser tiered rating agency, and they're disproportionately selling those mortgages to Fannie Mae and Freddie Mac. Well, guess who stands behind Fannie Mae and Freddie Mac? Us, the taxpayers of the United States of America. Now, we're not at a place where Fannie Mae and Freddie Mac is buying so many of these mortgages from mortgage lenders that are disproportionately risky mortgages. But if this phenomenon continues to develop, as it appears to be developing, it could pose consequences for Fannie Mae and Freddie Mac, both of which are still in receivership still, because they never quite got out of receivership from the 2007-2008 crisis, if memory serves. So yes, long way of explaining, yes, there's an impact climate change on insurance, on housing pricing, on mortgage lending, on mortgage lenders, on the secondary market. And that's just one impact.
Wow. Okay. Well, we have a lot of questions, so hopefully we'll get to them. Next question. What have insurance companies fought back against restrictions on their ability to invest in fossil fuels, filed lawsuits against such rules or regulations?
Terrific question. So in 2016, when I required I think it was about 3,000 insurance companies that were licensed to sell insurance in California to start reporting publicly their investments in oil, gas, coal, and utilities that derive over half their electricity generation from fossil fuels. I got a very nice letter from 12 conservative states attorneys general and one governor threatening to sue me because I was simply asking that this information be disclosed. Now, I don't know for sure, but I heard that the folks behind that were the insurance companies that I was asking to disclose this information. Actually, I've had it on pretty good authority that they were behind that letter, as well as the oil and gas industry. Now, I'm a lawyer, and I wrote back a very thoughtful letter that provided all of the legal basis for my ability to ask these questions of insurance companies that might be headquartered in other states, but were doing business in California. And I explained that it would be financial regulatory malpractice for me not to be asking these questions because the insurance companies had no idea what they were holding and weren't thinking about the potential risk to those assets as we transition from fossil fuels due to market conditions, policy, technology, whatever. They weren't thinking about what implications that might have for the value of those assets. They weren't thinking about whether coal, for example, might become a stranded asset on their books. So it was entirely appropriate and indeed necessary that I ask these questions so I had better insight, the public has better insight, investors, insurance companies have better insight, and frankly, the insurance companies themselves have better insight into what's on their books. But at the end of the letter, I said to the 12 conservative states, attorneys general and governor, but if you want to sue me, bring it on. They didn't sue, but yes, there was considerable pushback to that request.
Okay, thanks. Okay, can you talk about reinsurance and the assessment of risk?
Absolutely. So reinsurers are insurance companies for insurance companies. They are big global enterprises, and they're in the business of writing insurance for insurance companies. Basically, what happens is the insurance company that, say, is writing home insurance or auto insurance or business property insurance will pay a premium to have coverage for some portion of the risks that the direct writer of insurance is taking. So the reinsurance companies have to have a lot of capital in order to take that risk, those risks. And what they're seeing, not surprisingly, is they're seeing their losses as a reinsurance company go up, as the insurance companies they're writing insurance for have more losses, and then make a call on the reinsurance contract or treaty, they call them treaties in some cases, requiring the reinsurance company to pay money to the insurance company to cover some portion of its losses. So as a consequence, reinsurance pricing is going up dramatically, particularly in the property and casualty space, not surprisingly. The other thing is to note is that the reinsurance industry, I mean, thank goodness they exist, right? Because it's a way of spreading that risk globally and raising capital to help cover some portion of that risk. But they are what economists call a natural oligopoly. You have to be really big to be a reinsurer. You have to have a lot of capital. You have to have a lot of expertise. I mean, several of us on this call couldn't just go out and form a reinsurance company tomorrow and be successful. Well, I know I can't. And so because there are natural barriers to entry, they tend to be few in number. They're profit seekers. They're not nonprofit. And they use their position to charge the prices they need to make a profit as well as cover risk. And so those reinsurance prices are going up. Now, what some states have done, Florida, for example, set up a taxpayer-funded reinsurer to cover both its private insurers as well as Florida citizens, which is the Florida version of what's called a residual market or FAIR plan that 35 states have enacted to write insurance for people who can't get private insurance. So there have been some states that are looking at doing that as well, create a taxpayer-funded reinsurance facility. There's even been a federal proposal to create a federal reinsurance for direct writers of insurance. So the arguments for this, for either a state or federal reinsurer, is that it would be nonprofit, and so it would be cheaper. So, I think as a state solution, that can help. What I've written about is I think there ought to be federal reinsurance for the 35 insurers of last resort, which are residual markets or FAIR plans that are writing insurance for people that can't otherwise get insurance in the private market. So the FAIR plans or residual markets, they're not state agencies, they're not taxpayer funded. They're involuntary private associations of the private insurance companies writing insurance in that state. They're set up by state statute. And basically states have said, look, since private insurers get to decide whether to write or renew insurance, we've got to have some place for people to go to get insurance. So we're not going to just let you off the hook, private insurers, and you can wash your hands of insuring people and just insure the risk that you can make money on. You're going to have to participate in this association. It's going to write insurance for the stuff you won't write. And oh, by the way, if this association called the FAIR plan or residual market runs out of money, we're going to look to you based on your market share to cover their claims. So that's how it's been done in most states. Those FAIR plans are, as you could imagine, facing increased policy counts. In California, the FAIR plan went from 180,000. When I left office, it's got about 450,000 people, right? Why? Because the private insurers are saying, we're not going to renew more people, or we're not going to write more new insurance, so people have to go to the FAIR plan. FAIR plans have to buy reinsurance. It's super expensive for them. Why? Because they're covering the riskiest risks. They're covering the risks that the private insurers won't cover. So the reinsurance is even more expensive for them. So a federal program of reinsurance for the FAIR plans, I think, would be helpful and would then allow that cost savings to be passed on to private individuals. I'm not ready yet to support a federal reinsurance program for the private insurers. I'd like to see them first begin to account for mitigation in their underwriting and pricing before we go to the federal government to provide that level of assistance.
Okay. Apologies to Trudy. I got out of order and I'm trying to stay in order, but you may have just touched on her question a bit. It says, what recourse does an individual homeowner have when their insurance is not renewed?
None. I mean, unless you are, um, unless you have evidence that you were discriminated against because you're in a protected class, like, ethnicity, race, religion, gender, insurance companies in every state, in the District of Columbia, and in the six territories have unfettered discretion to decide whether to renew insurance or write insurance for homes, for autos, for businesses. Um, you know, the only way to change that would be to change the state law. And the insurance industry has been very successful in preventing any state law from passing that would in any way, shape, or form impinge on their discretion to decide whether to renew or write insurance. Now, I do think that states should enact, and I think that it's politically viable for states to enact legislation that requires the models that they use to make those decisions account for mitigation. Um, so that's something that the states should do. There's a bill that's been introduced in Colorado that takes some steps in that direction that requires the models to account for mitigation. So that would be helpful. But you as an individual, and what that bill also does is it gives you the right to have your risk score in Colorado provided to you, and then you get a right to appeal to the insurance company with regard to that risk score, but then it stops at that, right? There's no appeal to the insurance commissioner after that. And no state has any right to appeal to the insurance commissioner with regard to non-renewal or not writing insurance. So the basic state of law is you have no recourse.
Okay, a sort of a related question. Are there ways we consumers can push back against the insurance industry that might have an impact other than than canceling our policies, for instance, rallies, protests, outreach to their officers, directors, other?
So there has been an active advocacy effort directed at insurance companies, led by the Sunrise Project and Insure Our Future and other organizations. That's direct, and also shareholder advocacy by As You Sow, which is a shareholder activist organization. The advocacy has been directed at company shareholders as well as the companies themselves to ask that they stop writing insurance for fossil fuels, ask that they stop investing in fossil fuels. And I think that's important, and those advocacy efforts are incredibly important, and folks can get involved in that. I would encourage you to go to Insure Our Future's website or the Sunrise Project's website to get involved in that. But the insurance companies have shown a great unwillingness to be responsive to that advocacy in this country. A little bit much different in Europe and Asia, where European and Asian insurance companies believe that climate change is happening, believe that it's caused by humans, believe we need to do something about it, right? So insurance companies in Asia and Europe are actually in alignment with their national governments. US insurance companies are not taking proactive positions on climate, are not agreeing to transition out of investments in or insuring of fossil fuels. So that's why I bring you back to those state bills that I mentioned, SB 222 in California, the bill in New York that would require transition from fossil fuels, the bill in Connecticut that would put a surcharge on premiums associated with writing insurance for fossil fuels, and then this fourth bill that I mentioned a moment ago in Colorado that would require the models the insurers use account for mitigation. I think the best expenditure of advocacy at this juncture is on passing state laws to require these things.
Okay. It says another question. Many people in California are counting on the FAIR plan. Early after the fire, it was evident that the FAIR plan wouldn't have enough funds. What can communities do to prepare for expense? Are there efforts for insurance companies to get fossil fuels to pay for the costs they pay out?
Yes. So Senate Bill 222 would require the California FAIR Plan to bring lawsuits against the oil and gas majors in appropriate circumstances to try to recover some of the payouts it's making associated with severe and extreme weather related events that are driven by climate change. And I think that's definitely an important approach, and one reason why I'm supporting and would encourage you to support Senate Bill 222. The other thing I think it's important for your viewers to understand is that, as I said a moment ago, 35 states have these residual markets or fair plans. The way they were originally set up was that the insurers were on the hook if they ran out of money. Now you might ask, well, why are they running out of money? Well, one reason is that they're insuring the riskiest risks. So the price of the fair plan or residual market insurance is going to be very expensive to begin with. If the state required the fair plan to have the same reserve requirements as a private insurance company, no one could afford the fair plan insurance. So instead, what states said was, look, we're going to charge based on risk, and you need to have enough money to cover a typical year. But if it's a catastrophic year, then the fair plan can look to the private insurance market based on its relative market share, and the private insurers have to kick in to cover any shortfall. Well, that rule was changed in Florida about 20 years ago, because you could imagine the private insurers aren't super keen about that. So they got a law passed in the Florida legislature that eliminated any exposure they might have to a shortfall from Florida citizens, which is the analog to a fair plan in Florida. Then insurers in Louisiana saw that a couple of years ago and asked for the same thing from their legislature, and they got it too. So what was it they got? In Florida, Louisiana, if Florida citizens or Louisiana citizens runs out of money, they assess all policyholders in the state of Florida or Louisiana respectively to cover the shortfall. In Florida, they call it the hurricane tax. It's happened several times now. Well, in California, until last year, the rule was the insurers are on the hook. Then that rule was changed by the insurance commissioner so that the insurers are only on the hook for the first 500 million, which sounds like a lot, but it's pretty much peanuts. And then after that, all policyholders are on the hook in California. So the California Fair Plan declared about 3 or 4 weeks ago it was $1 billion short of what it needed to cover claims. And so the commissioner issued an order. The first 500 million will come from the insurance companies. The second 500 million, they're going to pass through to all the rest of us. And it remains to be seen whether the fair plan is going to need more money. So one thing to keep an eye on in your state is that other states, insurance industries, are trying to move legislation in the state that would change their fair plan to put the burden on you as a policyholder as opposed to on the insurance industry. So there's a bill like that moving in New Mexico, for example. So this is, what I anticipate is going to happen is that every state that has a fair plan, there's going to be an effort by the insurers to move legislation to get them off the hook if their fair plan runs out of money and put all of us on the hook. So something for consumer advocates to keep their eye on and something to keep an eye on in your state.
Okay. Next question. Excuse me. With so much current deconstruction of societal safeguards, what does your crystal ball tell you about the future of insurance?
Well, I think, as I said, I think we're marching steadily towards an uninsurable future in this country and throughout the globe because we're not doing enough fast enough to transition from fossil fuels and other greenhouse gas emitting industries. There are some things we can do, as I've talked about, in the short or midterm to make insurance more available. And I think we should do all those things. But in the long run, what I fear is going to happen is that the increased severity and frequency of severe weather related events is only going to climb because global temperatures are climbing. And as I said in my intro, there are new things that are becoming substantially more negative in terms of perils, like severe convective storms, that climate change is causing as well. So, not only are the things that have been bad getting worse, but new things are getting very, very bad too. So I'm not optimistic. I mean, I think that's why we have to redouble our efforts. That's why I'm so appreciative that you've come together as an organization to work on this issue, because it's, at the end of the day, we've got to focus on the cause, right? We can, as we have, talk about a bunch of things that could be done in terms of the insurance regulatory, insurance legislative space that will make things better. But even those things, I fear, will be overwhelmed by the rising risk driven by rising global temperatures. So I'm sorry to end on such a less than optimistic note, but I would encourage you to support those things that can make a difference. And also, as you are, continue your leadership across the country, notwithstanding what's happening at the federal level, to focus on transitioning um, faster and more comprehensively towards an economy that is not so reliant on greenhouse gas emitting industries.
Okay, well, I want to be respectful of the time and we are running out. So I think I'll stop questions. There were some more, but unfortunately we won't be able to get to those. So Dave, on behalf of ECA and our visitors, thanks so much for your generosity, effort, time, and the content you've shared with us today. I would also like to remind everyone that in just a moment, we will host a 15-minute action party in collaboration with the wonderful team at Climate Action Now and the app they have developed to easily take meaningful actions. Please stay with us if you can. With that, I will turn things over to Climate Action Now. Again, Dave, thanks so much.
My pleasure, and thanks for your leadership and advocacy and for making such a difference. Thank you.
Thank you so much, Dave. We really appreciate you being here. Kaylee and Liz from Climate Action Now, you're here to get us started on our action party, and we are very excited to hear what actions you have for us this evening.
Awesome. Thanks so much, Jen, for having us. As always, we're super excited to come hang out with you guys for 15 minutes and take action together. If we haven't met before, I'm Liz Bridgewater, the Director of Outreach at Climate Action Now. A big part of my role at Climate Action Now is producing the climate action parties that you may have heard about, bigger versions of these mini action parties we do with you guys here tonight. Here today as well is Kaylee Beam, the Director of Content at Climate Action Now. If you're a user of the Climate Action Now app or any of our resources online, Kaylee is the driving force behind all of those actions, as well as coordinating our incredible team of volunteers who help make actions, many of whom come from Elders Climate Action. So we're super grateful for you guys and love the partnership that we have with you. Tonight, Kaylee is going to launch us off with sharing how to take action tonight using the app. So take it away, Kaylee.
Yes, thank you for the introduction, Liz. I'm going to share my screen really quick so that we can get started with this action party. So you should be seeing our goal tracker now. On the left, we have this image of a globe that will iterate and fill in as we take action here tonight. And on the right side, we have the QR code. So feel free to go to your camera app or wherever you go to take photos, hold up your camera to that QR code, give it a couple seconds, and then you should get a pop-up that says Climate Action Now. On my phone, it's like a little yellow bubble. If you tap on that, it will take you to tonight's campaign if you have the app already, or if you don't yet have the app, it will take you to the App Store to download. And once you download it, you'll just need to register, make a profile, and once you complete the sign-up process, you'll be taken right to the campaign for tonight. If the QR code isn't working for you, there's a couple other options. I'll drop a link in the chat that you can type into your phone's web browser, which is this one right here, the CAN app link/fossil fuel investment. So if you use that link, that's another way you can access it. There's some links in the chat throughout this 15-minute period that you can use to take actions online if you're more comfortable on the computer. Tonight's campaign is we have a couple actions targeting insurance companies. We have some more broadly reaching out to corporations, retail corporations, tech companies, and also universities. And the name of the game tonight is really just focused on divestment and disassociation. So the actions are broadly focused on encouraging these different companies and influencers to stop supporting fossil fuel companies and oil and gas development. So I'll get started dropping those links in the chat for those of you who like web forms.
Thanks so much, Kaylee. And as Kaylee was saying, we've got quite a wide range of actions tonight. So one of the capabilities of the Climate Action Now app is probably our most common one is for folks to reach out to your legislators, your elected officials. But it's also possible to reach out to folks who are decision makers in other elements of our economy. As we all know, climate change has implications across our entire economy and society. So you'll be reaching out to lots of folks across that full spectrum of decision makers and influencers tonight. You'll see some examples of reaching out to big banks, to major car companies, insurance companies, of course, as well as a number of major brands spanning industries like clothing, pharmacy, universities, retail operations. So got a whole wide range of folks to reach out to and make some noise with tonight.
Yes, and the first web form I just put in the chat, it's to contact, I think it's 7 or 8 major insurance companies and make sure they're aware of 2020, how many billion-dollar disasters there were in 2024, and urge them to meet the moment with climate action. So yeah. Unfortunately, if you take actions through the web form, you do not earn trees like you do in the Climate Action Now app. But it's still a great alternative if you prefer using web over the app.
And Jen, I know you guys have taken a bunch of different actions this year. Do you have an updated tally recently for how many actions Elders Climate Action has taken this year?
For this year, that is a great question. And you know what? Let me go look.
Awesome. Sounds good. And maybe while Jen's checking on that, I'll just share we've got another action party coming up tomorrow night. So if you're familiar with our action parties, you may have seen we previously did an event called Save the EV Tax Credits. And a big part of our actions at that event were focused on targeting the Trump administration's recent attempts to, or recent interest, I would say, in cutting the EV tax credits, which have helped make it easier to buy an EV. But we're bringing that event back with a new set of panels and a new set of actions focused on congressional Republicans because the EV tax credits are on the chopping block in the upcoming weeks. So we have that event coming up next Wednesday, if that's of interest to anyone to join. I will drop a link to that as something to register for.
Looks like so far this year, Elders Climate Action is at 4,401 actions. But that's not including anything from March yet. So that's just that was just from January and February, and that is our action parties and all of our regular just daily action takers. So that's, I always love looking at those numbers and seeing how many actions were taken.
Yes, that's amazing. That's so many.
That's awesome.
Yeah, so I can only imagine it's probably somewhere probably around closer to 6,000 right now, because we're close to the end of the month. And so we'll be doing that. We'll be updating our report.
Awesome. Looking forward to
Very cool.
seeing the updates. I'm curious how many trees that would translate into. I don't know what our action to tree ratio roughly is, but I'm sure that's a substantial portion of trees that have been planted as a result of all that.
Hey,
speaking.
Liz, and Kaylee, I have a question that just came into the Q&A box that I think I'm gonna share with all of you. It says, I've been using CAN for a couple of years now and recently moved to Montana from Massachusetts. The federal reps here answer my outreach emails with emails echoing the intent to support what's going on in DC. Do you suggest that I write back, or is it hopeless? What are your thoughts in response to that question?
Mm-hmm.
Yeah. I mean, I think it's really hard to know the extent to which, our words and actions can really affect change, right? I think it's easy to say it does feel hopeless, right? There's no guarantee, even if you do respond to your reps, that it will turn into anything. But at the same time, I think in this moment, like all we can really do is express our opinion and express our discontent. And so I think for that reason, and not going to settle for this being like the status quo. So that's just my off the cuff reaction to that.
Yes, I'll second that, Kaylee. I think a big part of the mindset that we have with climate action now and all the wonderful people who take action with us is that your voice is really your superpower. And even if it's just maybe feels like one person in a district who's making some noise about an issue, that's still at least one person making sure that that issue is getting raised. I hear sometimes about how, staffers and whatnot, well, it's essentially a tally in some ways. And even just getting that tally out there can make an impact to see that at least one person in a district that might like to think that they don't necessarily have folks who care about that issue still do care about it. So I feel like there's, a whole wide spectrum of the experiences people have with their elected officials responding to specific asks that have been made of them. And it can certainly feel disheartening to be on the end of the spectrum that's in a location where there are not as many other people saying the message that you are. But I still do think that that action in and of itself of just expressing that you wish to go in a different direction than you currently are as a district can be very impactful. So thank you for continuing to take action, even in a place that might not feel like it's being as receptive to your advocacy.
And I think in those places, it's even more important in many ways. It's very important that we are expressing what we want and what we want to see, and making our voices heard, and making our opinions known about these issues. And I think that the only way for us to do that is to engage, to try to build relationships, to try to engage with those offices, to try to tell them who we are and what we want. And so any mechanism of engagement with decision makers, I think is important, and especially in moments like this moment right now. So I would encourage us. I think that also, I think that the opposition, the climate opposition, wants us to feel discouraged and hopeless so that we don't contact them anymore, and so that we stop trying. And I think that it actually is just a testament to our power as a collective and as a movement, and that they wouldn't be so afraid of us if our advocacy and our efforts weren't actually having an impact. And so I think that when we stop and remind ourselves of that, it's like, this is like Liz said, it is our superpower. They're trying to stop our superpower, and we can't and shouldn't let them. So we will keep showing up in their inboxes and in their voicemail systems and on their schedules, requesting meetings, and at their town halls that they are trying to avoid, and letting them know what needs to be said. So I encourage us all to keep doing it, keep taking those can actions, even if it feels like they are hopeless, because they're not. They're actually all power building for the moment where we will be able to make those changes and make those moves. And I think that they're also power building in places where we can currently make those changes and make those moves. So whether that's local, state level action, or within our own communities. Look at us, 266 actions. We are getting very close to our 300 action goal. That's always so exciting when you see those numbers ticking up.
Yeah, I didn't want to interrupt, but we blew right past our goal, so I went ahead and updated it to 300. I think we can get there by the end of the 15-minute period.
Oh, great. What did we start with as a goal, Kaylee?
250. So we
great.
sailed right past that. We're onwards and upwards to 300.
That's so great. It's always nice when we get to expand our goal.
Mm-hmm.
Love seeing that blue marble get filled up as we go.
Dwight, I see your comment. It says it might help for climate deniers to hear that so many people are otherwise informed. And yes, agreed. And I think the number of climate deniers is actually much smaller than we might think.
Yes.
Yale Climate Connections, or Yale Climate Communications, does some great research and surveys on that type of thing. And it seems like that number just keeps getting smaller and smaller as over the 10 years that I've been watching data. So
Yes, I think they just recently released their newest reporter update. Of course, I can't remember the numbers off the top of my head, but maybe I can find it and drop it in the chat. But it's very hopeful, the executive summary. It speaks to what you said, that there's a lot fewer climate deniers out there than you might think.
yeah, I think, I just saw that same report, Kaylee. If you have it, that'd be a great thing to share.
Yeah, I think we actually got an action on it in the app, so it is in my browser history already. Let's see. Let me drop it in the chat. And we reached our goal again. Amazing, everyone. You cannot be stopped. That's great.
Yay. And I love it. There's 24 of us on this call still. So our audience has gotten very small compared to what we were just a little bit ago, but to see all these actions taken by such a small group of people, and it is a reminder of that a small group of people can have a tremendous level of impact in a short amount of time, right? 15 minutes. That's all we're giving is 15 minutes, but we are making a lot of outreach right now in this 15 minutes. Kaylee just dropped the last web form for tonight. So if you are using the online version, the last link is in the chat box for you.
Yeah, tonight's campaign, I think we had 4 regular contact insurance companies and your elected officials, and then we had a couple of petitions petitioning major banks to rejoin the Net Zero Banking Alliance, and one urging universities that were found to invest heavily in fossil fuel companies, encouraging them to divest and disassociate. So definitely some good actions, and thanks for everyone who participates via web form. We love to see that any form of engagement, but that you love this alternate form of engagement too.
Well, I just learned that methane is and natural gas are the same, and we call it natural gas. I actually hadn't realized that, so I learned something.
Well, thanks everybody. We are going to send out the recording and all the links, and we'll make sure that you get all of these action links also, and the QR code for this set of actions, so that if you want to keep taking actions from this this carousel, you'll have access to it. But thank you so much. And tonight we're ending at 327 actions, and we started with a goal of 328, 329. See, we're just going to keep going. So thank you so much, everybody. I hope everybody has a wonderful evening, and we'll see you next month.
Thanks, Kaylee and Liz. Thanks, Jen.
Thank you, everyone.
Thank you, Mark, for hosting.
Sure thing. See you tomorrow.
See ya.
Bye.